Welcome to This Explainer. Today we're diving deep into the absolute mechanics of corporate assurance and governance. We're actually going to tackle one of the most massive underlying problems in the entire business world, and that is the problem of trust. I mean, how do we actually know that a company's financial statements are accurate? How does the whole global economy function without just collapsing into total suspicion? Well, let's find out.
So hooking right into our core dilemma, you have to ask yourself, how can you rely on corporate information when you absolutely cannot verify everything yourself? Think about it. When a massive global corporation claims, that they made $1 billion in profit or that they have these robust internal controls, you can't just take their word for it, right? But at the same time, you can't exactly waltz right into their headquarters and start opening up all their filing cabinets. And whether it's assessing quality, accuracy, performance, or even just basic existence, we are constantly facing a trust deficit. We simply lack the time, the physical location, and frankly, the highly specialized skills you need to verify a giant corporation's data. So, because we can't do it ourselves, we're forced to rely on external verification. We literally need someone else to give us that assurance.
Okay, here's our roadmap for today. We're going to cover 1. The need for assurance, 2. The 5 elements of assurance, 3. Corporate governance explained, then 4. The UK Governance Code, 5. Auditor rights and duties, and finally, 6. Resignation and removal.
Section 1. The need for assurance. Why we need auditors.
Let's look closely at the exact phrasing of this definition. An audit is the independent examination of an expression of opinion on the financial statements of an entity. Now, I really want to highlight the crucial keywords here, independent and opinion. Independence is the absolute bedrock of this whole thing. Without it, auditing literally has no value. And opinion reminds us that auditing relies heavily on professional judgment. There are no absolute mathematical certainties or 100% certifications of perfect accuracy here. It's really about an expert's independent, well-founded opinion.
Section 2. 5 elements of assurance. Building the foundation.
Think of an assurance engagement kind of like building a house, right? It sits on 5 foundational elements. First, you need the people. That's a 3-party relationship between the practitioner, like our auditor, the responsible party, which is usually the company's management, and the intended users, like you and me, the shareholders. Second, you need an appropriate subject matter to actually look at, like the financial statements themselves. Third, suitable criteria. These are your benchmarks, like the International Financial Reporting Standards, so we aren't just guessing what good actually looks like. Fourth, you need sufficient appropriate evidence to back the whole thing up. And finally, everything culminates in a written assurance report that contains a clear conclusion.
Now, that final report comes in 2 different flavors, so to speak. Let's contrast the gold standard of positive assurance, which is also known as reasonable assurance, against the much more restricted negative assurance. Positive assurance is what you get in a standard statutory audit. The auditor explicitly comes out and states the financials present fairly in all material respects. Boom. But sometimes, like when they're looking at future budgets or forecasts, giving positive assurance is practically impossible. In those tricky cases, you give limited, negative assurance, which basically just says, hey, based on what we looked at, nothing has come to our attention that causes us to believe this is wrong.
Section 3. Corporate governance explained. The corporate environment.
So here's the great vulnerability of modern corporations. Shareholders own the company, absolutely, but they don't actually run it. The board of directors runs it day to day. You end up having thousands of relatively passive owners giving a small group of directors more or less free rein to make huge strategic decisions. And this dangerous disconnect creates a massive agency problem. Think about it. If management is essentially marking their own homework, how do the owners ever know the actual truth? Well, this is exactly why strict corporate governance, backed up by an annual external audit, is absolutely critical to add credibility to the director's performance.
Section 4. The UK Governance Code. Setting the rules.
To solve this big disconnect, we look to establish frameworks, and the UK Corporate Governance Code serves as a really prime example of global best practice here. The code focuses heavily on the division of responsibilities. So the totally crucial point is that no one individual should ever dominate decision-making. You've got executive directors, like your CEO, who are in the trenches running the business. Then you have non-executive directors, or NEDs, providing independent oversight, strategic guidance, and basically holding management's feet to the fire. This is exactly why the CEO and the chair of the board cannot be the same person. You absolutely must balance that power to protect the shareholders.
Building on that whole idea of independence, we get the audit committee. Now, the code says this has to be entirely comprised of independent, non-executive directors. This committee is absolutely vital. They monitor the integrity of the financial statements, and they are the specific ones who recommend appointing or removing the external auditor. Essentially, they act as the critical, independent forum that links the board directly to those external auditors, making sure management can't just unduly influence the audit process behind the scenes.
Section 5. Auditor Rights and Duties. The referee's superpowers.
To do their job effectively, auditors are armed with statutory rights that honestly act a bit like superpowers. They have the absolute right to access all the records they require. They have a right to demand information and explanations from management. And maybe more importantly, they have the right to be notified of, attend, and actually speak at general meetings. This means that if management is being difficult, obstructive, or clearly trying to hide something, the auditors can completely bypass them. They can use these specific powers to communicate directly with the shareholders they were hired to protect in the first place.
But to use those powers effectively, an auditor really must maintain an attitude of professional skepticism. Let's demystify this heavy bit of jargon for a second. It doesn't mean the auditor assumes everyone is a liar, or that management is inherently corrupt or dishonest. It simply means acknowledging human nature. Look, people make errors. People are overly optimistic, especially when they're pressed for time or trying to hit targets. So professional skepticism just means you always require proof. You constantly question the validity of evidence, and you essentially collect hard data to support every single claim being made by the company. Trust, but verify.
Section 6. Resignation and Removal. Corporate Drama.
Finally, let's enter the realm of corporate drama to explore what happens when the critical relationship between an auditor and a company totally breaks down. What actually happens when an auditor steps away or is aggressively forced out by management? Maybe the auditor was too good at their job. Maybe they completely refused to ignore a glaring issue and threatened a modified audit opinion, and now management just wants them gone. Thankfully, the rules ensure this can't just happen in the dark.
Whenever an auditor leaves, whether they resign or get removed, they must issue what's called a Statement of Circumstances. This is a legally required written document explaining exactly why they are departing. Now, while a resignation might be for perfectly innocent reasons, maybe the audit firm is just downsizing their client list, this document is incredibly vital because it can expose deep, hidden concerns about the company's activities directly to the shareholders and to regulatory authorities. It's essentially the auditor's final alarm bell.
And here is a very specific, high-drama scenario that illustrates perfectly just how fragile independence can actually be: overdue fees. If a company owes the auditor a massive amount of money for past work, it seriously threatens the auditor's independence. Why? Well, because the auditor might be super tempted to issue a compromised, soft audit opinion just to ensure the company survives long enough to finally pay their bill. To prevent this kind of conflict, the rules are super strict. If fees remain unpaid, the auditor shouldn't incur more chargeable time, and ultimately, they absolutely must resign. Independence simply cannot be bought or leveraged.
Wow. Okay, we've covered a lot of ground today. From the basic need for assurance to the intricacies of corporate governance and, of course, those auditor superpowers. But I want to leave you with this final provocative thought. The entire global economy, every major stock exchange, every giant investment fund, it all functions only because we have independent referees out there verifying the truth. If an auditor ever loses their independence, that whole delicate system of trust just collapses. So ask yourself, the next time you read a company's glowing financial report, who is the independent referee standing behind those numbers? Thank you so much for joining me for this explainer, and keep questioning what you read.